Good day. For this session, we're going to discuss and have construction contracts under IFRS 15, which is a revision of the previously issued topics about construction contracts or long-term construction contracts coming from IAS 11. IAS 11 has already been superseded by IFRS 15 provisions. Then make sure to check out discussions about IFRS 15 or PFRS 15, revenue from contracts with customers. So it's already also in the channel. You can check that out. Forgive me for the bootleg quality of the PDF file. So this is the best that I got. And so just bear with me with the discussions. So again, construction contracts discussions are based on PFRS 15 provisions. So if you are able to read or already watch the videos discussing PFRS 15, so this is not something to be difficult to start for introduction of construction contracts. So learning objectives is that we should be able to apply the principles under PFRS 15. Second is to account for contract costs on construction contracts. If you say account, so we talk about again the four areas of the standards. Recognition, when do we record on the financial statements? Measurement will be how much. Presentation will be what will be the classification on the financial statements, and disclosures will be the additional information or the additional information in the notes to financial statements. Number three is to account for onerous construction contracts. If we say onerous, this simply means that the contract is burdensome on the end of the parties involved in that contract. So to discuss, a construction contract is basically composed of two parties. One is the contractor, that is the construction company in which that particular entity is the one in charge to construct the particular non-current asset, normally a PPE item to be constructed. Then the other party is, of course, the contractee, also known as the buyer or customer or consumer, or the entity that pays for that particular construction contract. So in other words, because we're talking about revenue from contracts with customers, we are at the end of the seller. The seller then is the contractor or the construction company. So let us take note that what is offered here would be the services of construction. And of course, to be able to perform construction services, we need to take note that costs should be involved or would be involved. So they are in the form of direct materials, direct labor, and factory overhead. Number four is what if there would be some changes in the contract in terms of consideration. So again, from PFRS 15, the contract becomes variable depending on the case or situation. Then there would be some modifications in the contract, so changes of scope in the contract or number of items to be made, and other changes in the transaction price. So for example, there could be some cost escalation clauses that we can meet later on. And then this means that the price could change because costs also can change. And we all know that the margin or the gross profit is imposed on top of costs. Number five, so account for construction contracts wherein the collectibility of contract revenue is uncertain or becomes uncertain. So what do we do in this particular situation or these situations wherein collectibility or collectability, it's the same, collectibility or collectability would be uncertain or becomes uncertain. Just like for installment sales, wherein if collectibility becomes uncertain, then we are going to make use normally of installment sales. But if it is become highly uncertain, so that's the time that we use cost recovery method. All right. So as introduction, again, for construction contracts, we have to follow the provisions under PFRS 15. So remember, the provision of PFRS 15 is applicable for all contracts with customers. And then this is regardless of the nature of the contract. So Any contract that involves revenue will, of course, be governed by PFRS 15, with exception of certain contracts like leases, in which we will follow PAS 17, insurance contracts, PFRS 4, financial instruments, and other items like non-monetary exchanges between entities. So in this case, for exchange transaction, this is not a sale transaction. Okay, so that's why they are exempted. They are beyond the scope of IFRS 15. All right, so definitions, actually, these are already being tackled in PFRS 15, so I will not go with that anymore. Then again, PFRS 15 supersedes PAS 11. Now, these 5 steps of the new revenue recognition model has been discussed already, but allow me to go over with them again so as to refresh ourselves or our minds with the revenue recognition principles under PFRS 15. So step 1 is to identify the contract with the customer. We have to know that there are parties, of course, in the contract. So the seller, we are on the part of it, and the customer. The contract is with a customer, and among other things, the collectability of the consideration is probable. So it's really highlighted here, probable, meaning to say that the possibility that something will occur or happen is greater than the possibility that it will not happen. That's probable. Second, or step 2, is to identify the performance obligations in the contract. So it's possible that there are goods or services to be delivered to the customers. And so we have to identify these specific goods or services to be delivered. And to be distinct, the goods actually, as promised, will be that the customer can benefit from the good or service by its own or with combinations in the bundle. And letter B, the promises are separately identifiable from each other. For example, if there are different or there are multiple promises or performance obligations in the contract. Step 3 is to determine the transaction price, which is the amount that the entity expects to be entitled to in exchange. The seller, of course, I was about to say buyer because the buyer will be paying to the seller, but this is on the part of the seller, in which the seller will be receiving this particular amount in the transaction or contract. Then step 4, out of the transaction price, then we are going to allocate the price to the performance obligations in a bundle. So we have to take note again, or once again, that only items in the bundle should be allocated respectively. Then using the relative standalone selling prices under, of course, IFRS 13 fair value measurement, and that is a level 1. So the fair values. In the absence, level 2, we go to similar markets. In the absence would be level 3, company assumptions like discounting of cash flows that will result to value in use. Step 5, recognize, or we now record revenue when or as a performance obligation is satisfied. So either over time, most especially with a construction contract, that we think of the progress of the contract over time, like a certain percentage at the end of the accounting period, because this is for multiple years, and for certain obligations at a point in time, because it is at this point in time when there is complete satisfaction of the performance obligation. So normally for a construction contract, it's going to be over time, since the progress of the contract will determine as to the revenue that will be obtained in the process. Okay, so definition of construction contract. The construction contract is that it is a contract. This is the definition from the standard, specifically negotiated for the construction of an asset or a combination of assets that are closely interrelated or interdependent in terms of their design, technology, and function, or their ultimate purpose or use. So basically, contract, there are two parties again, the contractor, the contractee, or the seller and buyer, or the construction company and the customer respectively. So there will be an asset that will be constructed or combination of them And then if combination, they are of the same economic characteristics or nature in terms of design, technology, and function. And then normally a construction contract is a long-term contract in which the contractor or construction company is tasked or in charge with construction of assets or combination of assets for a fee, and the consumer or buyer or customer will be paying that fee, also known as the contract fee, to the contractor or construction company. So here are the contracts that are included. So example of that will be the contracts for the rendering of services, which are directly related to the construction of asset. For another one will be for the destruction or restoration of assets, including, of course, the restoration of the environment following the demolition of assets. So it's possible that for us to construct a certain asset, then we have to restore some assets, or let's say environment, because probably the environment has been affected by the construction following the demolition. So it could be that there is an area there where there is an existing asset, and then that has been, or it has been demolished or destroyed, and it needs to be restored in the process. All right. So construction contracts are generally long-term. Of course, this will be done at long-term or more than 1 year. So that's why I also said that the topic is construction contracts or long-term construction contracts. So one concern or issue would be how to account for these contracts, and when do we recognize the timing of contract revenue and contract costs. So in terms of application though, here are the steps to be included. But then again, these are provisions from PFRS 15. So allow me only to pick the specific parts which are important. So step one is identify the contract with the customer, in which the contract should, of course, could be in any form, writing, orally, or implied. Then the rights should be there, payment terms, commercial substance, and then which means that there is an additional value in terms of cash flows in the contract, and it is probable in the collection. So take note that all of them should be satisfied in order for the revenue to be recognized. Then if ever cash has been received prior to the rendering of services, then liability will have to be recognized. That is unearned income. Could be current or non-current depending on the time. But then again, because this is a long-term construction contract, so it will be a long-term unearned income. All right. So when do we transfer liability to revenue? If there are no remaining obligations, could be all or substantially, meaning significant portion, and then the contract has been terminated or ended, and the consideration received is non-refundable on the part of the seller. For a combination of contracts, it should be that they have again the same economic characteristics in such a way that they can be negotiated as a single package. On the other hand, we have to segregate multiple contracts if ever they don't share the same economic characteristics. They're not similar. They are not, of course, let's say identical, if that's the term. And let's say that they do not belong in the same basket of prices. Because normally, if remember, it is said here that just because the contracts are negotiated at the same time, that we can say that the contracts belong to the same package, or that we are going to combine them into one. So as said, remember under PFRS 15, we are going to do the analysis contract per contract. Next, for step two, we identify the performance obligations in the contract. So we have to know the distinctness of every good or service. If they're individual, they belong to a bundle, or they are series or in a series. For distinct, this is actually recognition of revenue at a point in time, while if series, normally over time. So take note, they are substantially the same and have the same pattern of transfer to the customer. So they could be in a group, but that is over time. A promised good or service is distinct if, I think I've said this a while ago, that the customer can benefit it as its own, as is, or together with other resources. And the promise is separately identifiable from other promises. So these two should be satisfied to become distinct. Then this has been discussed already in our discussions on PFRS 15. So allow me to skip some parts. This one, performance obligations include only activities that involve the transfer of a good or service to a customer. Yeah, so any activities, any actions related to the delivery or transfer of a good or service are performance obligations, but they do not include administrative tasks to set up a contract. So normally, these are the expenses or costs which are incurred prior to the establishment or perfection of a contract. So that's why they are not, of course, part yet of the performance obligation. So such would be expense immediately under general administrative expenses. Here is an extract from IFRS 15 or excerpt. So allow me to read for this one. Example 10, goods and services are not distinct. So we will see an entity, a contractor, enters into a contract to build a hospital for a customer. The entity is responsible for the overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation, procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. Criterion A, the customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. So in this case, the requirement here for the good to be distinct has been complied with. So that's why it's capable of being distinct. So the promised goods and services are capable of being distinct. Criterion B, the promise to transfer the good or service is separately identifiable from other promises in the contract. However, if this is just the requirement or criterion, then it would not be automatic that the contract or the said goods and services in the contract are really distinct within the context of the contract. So to read or to it, that is, the entity's promise to transfer individual goods and services in the contract are not separately identifiable from other premises in the contract. This is evidenced by the fact that the entity provides a significant service of integrating the goods and services which are the inputs into the hospital, the combined output for which the customer has contracted. Very true. So the point is that these activities here, these tasks, engineering, site clearance, they would contribute to the output that is the hospital. So in other words, these performance obligations are not distinct and separate performance obligations. So that's why they would not result as being distinct goods or service. In fact, for criterion A, so the customer can benefit from this one individually. So let's say the management of the hospital can benefit individually from engineering, site clearance, and so on. So this is, for example, a case wherein perhaps the engineering service is given by one entity, that is the engineering company that provides engineering services, and so on. So different activities done by different entities. So those are separate services provided. However, it appears that these services are provided by one entity contractor in relation to this contract. So this means that it would not be distinct. And of course, the conclusion is that we need to comply both criteria, as said a while ago. So because both criteria are not met, therefore the goods and services are not distinct. Again, they contribute to the construction of the hospital, so clearly they are not distinct. For satisfaction, as said, it can be over time or at a point in time. over time, if of course it takes time for the performance obligations to be finished, and such should be a measure of progress over the contract. Then the entity's performance would create or enhance an asset, for example, work in progress, that the customer controls as the asset is created or enhanced. Then the performance does not create an asset with an alternative use. So in other words, it does not, of course, like produce another asset with an alternative use to the entity, and then the entity has an enforceable right to payment for performance completed to date. So in this case, the three should be complied with for the performance obligation to be satisfied over time. In this case, for letter C, there is like a date that is set for it to be considered as at a point in time. So alternative use, for example, if an asset can be used in another situation, and then the entity, the construction company, has enforceable right to payment for performance completed to date. So in that case, there's clearly an asset, separate asset that is produced of the process. Therefore, it is not going to be over time. It is at a point in time. That's the point of alternative use. Then enforceable right, if, for example, an entity can be indemnified with amounts or can be given payments or can be reimbursed in order to cover sufficiently the cost associated with such performance or such construction of an asset with alternative use. So again, as said, many construction contracts normally is satisfied over time. However, we have to analyze the surrounding factors if all information are met, because so far it should be that two, if there are two items, all of them should be met. In identifying the contract with customer, it says there that, of course, like all criteria should be met also. Otherwise, it is going to be assumed it is at a point in time. So initially, over time, if you do not comply all criteria, so at a point in time. All right. So let's have an example here in this case. To continue, this is a case extracted from IFRS 15. And then this is example 15. Asset has no alternative use to the entity. Remember, the requirement in the previous page here is that for a certain contract to be recognizing or to lead to the recognition of revenue over time based on the percentage of completion is that it should be that the asset or the assets, if these are group of assets, has or have no alternative use to the entity. So the entity that is performing, we are on the part again of the seller. So this is the construction company performing the services. It would not create an asset with an alternative use to the entity. So meaning the entity can make use of it. This entity is again the construction company or the contractor. And then does not create an alternative use for an asset or an asset with an alternative use, and the entity, meaning the construction company, has a right, enforceable right, to payment for a certain performance completed to date. So meaning, as what I've said again in a lot of occasions a while ago, that the entity can be paid based on the measure of progress to date. So progress of completion could be 10%, 20%, normally increases along the way unless there would be variation and estimates could change, but normally it would increase over time. And so that if the two requirements have been met, then that's over time. Now, based on this case in which the entity enters into a contract with a customer, a government agency, to build a specialized satellite. The entity builds satellites for various customers such as governments and commercial entities. The design and construction of each satellite differs substantially. on the basis of each customer's needs and the type of technology that is incorporated into the satellite. Since it is not stated that the asset has no alternative use, but because it is the title, and so we would say that, oh, the first part has been complied with. However, there has been no mention that the entity, meaning the construction company, can be paid based on the percentage of completion to date. Again, it's not here, so meaning it is at a point in time. So the payment is to be given, and payment can be enforced once a certain satellite has been made or constructed. So meaning it would be per item delivered or finished or completed, not like overall a percentage of completion of such. Could be on one satellite or the groups of satellites with same economic characteristics. But I suppose in this problem, it is clearly stated that the satellite differs substantially. So meaning to say, it's really going to be like instead of the progress just even with one satellite, it would be like the completion of every satellite. So meaning at a point in time. Then here is another situation, so enforceable right to payment for performance completed today. Let us check the additional information. The payments are non-refundable unless the entity fails to perform as promised. If the customer terminates the contract, the entity is entitled only to retain any progress payments received from the customer. The entity has no further rights to compensation from the customer. Okay, so there is a mention here about the progress payments or payments based on the performance to date. So in this case, then it can be a certain contract in which the revenue is to be considered or to be recognized over time. Take note also that the payments are non-refundable. So if that's the case though, but if you are going to look at the conclusion, because the entity does not have a right to payment for performance completed to date, so the entity's performance obligation is not satisfied over time. All right, so let's check. Even though the payments made by the customer are non-refundable, the cumulative amount of those payments is not expected at all times throughout the contract to at least correspond to the amount that would be necessary to compensate the entity for performance completed to date. All right, so that's the analysis. Let us check here. So by this sentence, the payment schedule, oh my gosh, it's something that the eyes would not clearly see. However, let's try our best, of course, to analyze things here. So payment schedule may not be the same as the performance percentage or the completed portion of the set performance that is made over time. So it's not clearly indicated here in the problem that it would be the case, as said also at the bottom part, that even though the payments made by the customer are non-refundable, the cumulative amount of those payments is not expected at all times to correspond based on the performance completed to date. This is because during the construction, the cumulative amount of consideration paid by the customer might be less than the selling price of the partially completed item of equipment at that particular time. So that's the reason. Firstly, advance payment at 10%, regular payments at 50%. Yeah, so it is not like increasing over time. So that's why it is not necessarily, or it's not going to be something that would comply, or a contract would not comply with the provision that it is to be considered with revenues over time. Instead, it will be at a point in time or of time where certain outputs have been finished. Okay, so good case also. Next is assessing whether a performance obligation is satisfied at a point in time or over time. All right, so this is another extract from IFRS 15, wherein a certain entity is developing a multi-unit residential complex. As we go along the way with the details, so there are some similarities in terms of floor plans and the sizes, but other attributes are different. For example, the location of the units within the complex, this multi-unit residential complex. Case A is that the entity will not be able to receive the payment based on the progress billings, but instead it will be payable when the customer obtains physical possession of the units. In that case, really, when you say progress, the project has not yet been completed. It is just a percentage. So this is a clear case of at a point in time. So when the goods have been finished or completed, then that's the time that we have to recognize the revenue. So it will be number of units completed times the price. Then that's case A. All right. So that's what I've said. It's at a point in time. What about case B? Entity has an enforceable right to payment for performance completed to date. So in this case, there would be certain provision here that the entity can receive based on progress billings. So let's check for further details. And the conclusion then is that it's not clearly stated here. Okay, here. The entity shall recognize over time because there is a reference to the measure of its progress towards the complete satisfaction of the performance obligation. So again, as what I've said, if there is no alternative use being created to the asset that is made by the entity, and then meaning another use, because supposedly when the asset was being constructed in behalf or for the client, so there is already an established use. But if there is an alternative use, then that would have impact on consideration of overtime recognition of revenue, which is a measure of the progress of completion. But for this one, it's not stated, it's just a matter of whether there would be payments based on the percentage of completion, so overtime. Then another one is that if the entity has an enforceable right to payment for performance completed to date. So in this case, since the entity could cancel the contract, in which case the customer's obligation to the entity would be limited to transferring control of the partially completed asset to the entity and paying the penalty prescribed. So in this case, the entity has a right to payment for performance completed to date. So even if there is, let's say, like default provisions and so on, in case that any of the parties would violate the terms of the contract, but still that would be resulting to recognition of the revenue over time. All right. So those will be the lengthy discussions for step two, that is to identify the performance obligations in the contract. Step three is determine the transaction price. As said, this is the contract price or the price by which the contractor or construction company or the seller is entitled to receive in the particular construction contract. But we have to exclude, of course, the value added taxes, for example, and the sales taxes, to be specific, the output taxes. Then the transaction price would normally include the contract price. Then in case that there would be variations, meaning there would be changes in the contract, then the amount to be added in case that there would be changes to scope of the contract. Then the transaction price may not be equal to the contract price established if there will be some variabilities. So these variabilities could be variable consideration, constraining estimates of variable consideration, the existence of a significant financing component in the contract, non-cash consideration, and consideration payable to customers. So this would really have impact to the value of the contract price to really result to transaction price not equal to it. So variable consideration would be like there will be changes in scope. I kept on saying that additional work to be done. Then constraining estimate. So initially, these are the estimates, but it would change later on, would either increase or decrease, or a financing component could be interest involved. Then additional consideration like non-cash and consideration that is payable to the customer. So in that case, if there's a liability to the customer, so it would have impact on the transaction price. Construction contract may be either though fixed price and cost plus. Fixed price is that's really the price as established, in which though in some cases there would be cost escalation. So overall, this can also have impact to the variability of the contract price, in which the transaction price is not equal to the contract price. Then cost plus contract is that to be able to determine the transaction price, that would be the total costs that are incremental in the contract and all other costs that are needed, and then we are going to add a certain percentage or margin. So in that case, that is going to result into cost plus contract, although the fee could be variable and fixed. So in variable, so there would be an agreed percentage, the total reimbursable cost. So just like cost plus margin approach, so or target pricing approach. While the cost plus fixed fee is that there is an additional fee to the cost. All right, then some construction contracts may contain characteristics of both. So case one, the contract price is at 6 million pesos, which is fixed. So this is a fixed price contract. If, for example, there is additional 15%, so this is a variable fee cost plus a variable fee contract. And then the contract states that there is reimbursement to the construction company for the total construction cost plus 2 million pesos. So this is with a fixed fee. Cost plus pricing is used when there is a challenge to accurately estimate. So it's possible that our estimates might be wrong later on. And then let's say this is a new contract, there are no prior experiences to this in which we can make some quotations or basis. And then although those are the cases, but in some situations like the cost plus variable fee, there could be some disadvantages. So one of that is because the construction company can impose the cost in the contract. It is possible that such construction company, meaning us on our end, that we are not going to be really performing the contract well, that we are going to minimize, if not eliminate the waste and be cost efficient. So we are going to make use of the resources as much as possible to the minimum levels to have minimum cost and minimum price, and so that it will be friendly to our customer or buyer. So in that case, because there is that particular clause, like on top of the price, we can just add the cost and then with a certain percentage. So that would be the case, because remember, the higher the cost or greater the cost, the greater will be the profit. And then the second one is that because the amount of overheads recovered and profit may depend upon the value of materials used. So this can also be the cost that there would be variabilities of the transaction prices along the way. So remember, materials could have price fluctuations or changes along the way. In this case, the fixed percentage though may be resulting to the transaction price to be bloated, too excessive, or too low for covering overheads and profit. So one example of that is, let's say if again the percentage is already fixed, but the prices have already increased along the way or decreased, for example. And then the contractee may end up paying an outrageously overstated contract price. So because of this particular feature variable fee, then that particular customer might be paying more. Then step 4, We now allocate the transaction price to the performance obligations based on the relative standalone selling prices or the market value. So it seemed like, again, when we acquire PPE using the lump sum or basket price, so we are going to allocate the transaction price based on the fractions developed out of the standalone selling prices. So discussions are already done for PFRS 15. Please refer. For step 5, we have already mentioned a while ago as to when can we recognize revenue at a point in time or over time. So if satisfied over time, this is based on the measurement of progress. Let's say 70% has been performed, so we have to recognize revenue equal to 70%. That's the case though. Then you call that the construction revenue, which will be presented in the statement of comprehensive income in the profit or loss or income statement section. Then for the methods for measuring progress, so we can make use of either input methods or output methods. I mentioned input methods because this is really the common one. The first part here is cost to cost, but that will be discussed in our part 2 for the discussions involving construction contracts. So for the methods for measuring progress, the entity shall use single method of measuring progress consistently for each performance obligation satisfied over time. So clearly here, this is now the emphasis of over time, because at the point in time is if we do not satisfy all the requirements. So if we satisfy all the requirements from steps 1 to 5, then we are going to use overtime. And we have to remeasure, and we are going to account for the changes prospectively, meaning in the current and future at the end of each reporting period. And our methods would either be output or input. Output is really first because this is based on the goods that are completed or finished. So that's why this is like prioritized by IFRSs. But input methods are discussed first. Anyway, if the basis would be whatever we place into the production or construction of certain non-current assets actually. So it will be based on the efforts or inputs expended relative to the total expected inputs needed. So example, let's say we talk about the resources consumed like the raw materials. Let's say the raw materials is for the contract totaling 1 million. And then for the first year, we used like 200,000. So 200,000 divided by 1 million, meaning that's 20%. And we multiply that with the transaction price, especially if the transaction price is not equal to the contract price, as explained a while ago, then that will be the construction revenue. So some examples would be cost incurred, like cost to cost, resources consumed, the labor hours, especially for the direct labor or the factory overhead for machine hours, or the time elapsed along the way. All right. So this would be our discussions for the first part, and hopefully you learned something. Then stay tuned for the second part or second session out of the series for construction contracts. So this might be a lengthy topic though. See you next time, and God bless.